Now, stocks are down sharply today, and the big names of the Dow are no exception. They're down almost 2%. But our next guest likes the biggest U.S. companies and says they're actually the best bet in a market that he expects to experience shocks every 6 months. Joining us now is Wayne Wilbanks, Chief Investment Officer at Wilbanks, Smith & Thomas Asset Management. Wayne helps manage more than $1.5 billion. So you guys have a lot of assets under management, but you are concerned about the economy, just as David Rosenberg was. Our next guest, Sri Kumar, is going to come on and say he thinks we could even have another dip here in the third quarter. Why are you then want to be long stocks even if you're worried about the economy?
Well, I think you have to have some amount of stocks in your portfolio, and the key is to have the ones that are going to drop the least if we have a downturn in the second half of the year, and that's what the Microsofts, the Intels, these companies are paying 3% dividends, generating huge cash flow right now. So it's almost like how little can I lose? It's not as much what's the upside I have in the
But wait,
stock.
Microsoft is a stock we talk about a lot. If you look at the last 10 years, hasn't done a heck of a lot. Why put your money there?
Well, I mean, look at it's just almost mathematics. They have $50 billion in cash. The company's only being valued for $200 billion. Okay,
so what? Because investors haven't recognized that over the last decade. What's going to make it change going forward?
Literally, the dividend by itself, if they just grow the dividend the way they've been growing it over the last 5 or 10 years, over the next 5 years, that stock could easily go up 30, 40%, 50%, just driven by the increase of the dividend rate. And the same goes for Intel, the same goes for Coca-Cola. I mean, it becomes the cash flow being generated by these dividends, which is why Einhorn last week is starting to come out and starting to buy the stock, because they're looking at these numbers and the stocks are incredibly cheap.
Before we get to the stock, let me just press you on one thing. We say in the intro, you expect this economy to experience shocks every 6 months. So it's definitely not smooth sailing ahead in your view.
Right. Well, I mean, I think that right now there's not a lot of margin for error. When you have these developed countries with their debt up to their over their heads right now, it doesn't give them a lot of room to be able to absorb a Japanese earthquake, for example, which what happened with their economy right now. So they already had a 2-to-1 GDP debt ratio, and now they have to deal with all the reconstruction spending. It couldn't have happened to them at a worse time. And so whether it's those type of events or whether it's just a slowdown in the economy, we just don't have a lot of room to be able to bail out, have another quantitative easing, for example.
But are you banking at all, like David Rosenberg, like others out there, that we are going to go back into recession?
Not really. We don't think so. The export market right now, especially for the U.S., we've got what the rest of the world wants. And so right now, if you look at the numbers coming out of the Caterpillars and the Deeres and the Norfolk Southerns, it's all being driven by what they're doing overseas.
Let me ask you about Microsoft now. I mean, you mentioned Einhorn's push for Microsoft. He's buying the stock. He hates Steve Ballmer, though. Hate maybe is a very strong word I don't need to use, but he wants him to leave, right? Ballmer's not making any headway with the stock. He's not making any headway in China, where every computer you buy has pirated Microsoft software. There's rumor that he was going to do a deal with Nokia today. Now, it's a rumor, and we don't want to encourage the reporting of rumors, but do they need to be desperate and do something like buy Nokia's cell phone business? Well,
they're generating, I think the first quarter, over $5 billion in free cash in the first quarter alone. So these guys are generating so much money. They can afford to go in and, buy a Skype. They can go in and buy Nokia's phone business, and it actually helps them build out a portfolio. So
or they can give it back to shareholders, as you point out.
Which I think is where they're headed. And then really, Microsoft represents sort of a generic, these large cap, high quality multinationals that are shipping stuff overseas, even if it's being pirated, are still, in our opinion, by far the cheapest place in the market.
Wayne, safe to say how you see it is it's going to be a tougher environment easily over the next 6 to 8 months, but you're making those long-term bets that those multinationals are going to do well 5 to 10 years from now. They're going to be the big players that are still going to be around. But safe to say it's going to be a rough 6 to 8 months because of the fiscal problems around the globe. We see the economy slowing down. Corporate profit growth is slowing down. I mean, it's going to be a tough environment.
Yeah, absolutely. And where you buy the market, if the market gets to the high end of the range, 1,400, that's probably all it's got, because at that point, the debt restructuring hits the paper. Then if you get down to 1,200, the stocks are so cheap like Microsoft, we can't see those type of names going much lower than they are right now. So you're in a range. So just be very careful. First, what's your allocation in equities? Get that right. And then secondly, when are you going to pull the trigger on owning these companies? And right now, Microsoft, those type of companies are very, very cheap.
I got to ask you about Intel. I mean, I understand what you're saying. These are big, generic names. You're looking at them really as sort of a defensive play. But the chip sector has been having problems as well. And obviously, with all the concerns about from Hewlett-Packard about PC sales, I mean, is that really a safe place to be?
At 9 times, 10 times earnings, it's all in these stocks. I mean, Intel's paying over 3% dividend, and it's going to be 4% 2 years from now, and it's going to be 5% 5 years from now.
So you like the dividend.
It's the
That's
dividend.
the theme here.
Cash flow is key. And having current cash flow is important.
Wayne, thank you so much. We appreciate it.
Thank you.
Wayne Wilbanks over at Wilbanks Smith and Thomas Asset Management.
We are